Hi everyone, good afternoon. Welcome you all to the annual market outlook, wherein we would highlight what things are set for 2026, what do we expect from the markets. Joining me today is Mr. Mohit Talwar, CIO at InvesTek. A little background about Mohit. Mohit brings in rich 20 years of experience across leading institutions like IDFC, IndusInd Bank, HDFC, Standard Chartered, and Deutsche. Mohit is known for blending his strong macro perspectives, his disciplined approach, wherein he focuses a lot more on, investing with the ideas of earnings. So, Mohit, great to have you with us after a year of consolidations, which we've seen last year. We've seen a lot of volatility across, market, be it India, be it US, or be it other markets. Well, we've seen a lot of valuation resets as well. We know the fact that investors are, now entering a phase where fundamentals and earnings visibility, moreover, wherein they need to have a disciplined, asset allocations given the momentum in the market. So looking forward, for a very detailed discussion with you today. A very warm welcome.
Thank you so much, Rinku. Thank you for introducing me to the audience, and looking forward to interacting with you.
Okay, so Mohit, if we look back at 2025, while we are aware, it wasn't a classic bull or a bear market. We saw different timings and corrections in the market. We saw very sharp foreign outflows, and yet by the end of the year, we saw indices delivering positive returns, even if it was merely a 5% returns. So now, as we enter 2026, how would you define the market phase now? From an investor's perspective, what is something that investors can look at in 2026?
So if I go back to 2025, there are two things which we have to look at. At the starting of 2025, the markets were quite expensive in terms of the valuations. Earnings were quite elevated, in terms of overall earnings. The past few years, when we see 2023-24, the earnings were quite good. As we move on to the closing of 2024 and starting of 2025, we saw earning downgrades happening. We actually, we saw about 4 quarters of earning downgrade. Post that, the valuations, which they were high, stocks which were trading on a very elevated valuations, largely mid and small cap stocks, which corrected very sharply. And I think there has been a healthy earnings reset, and there's been a healthy valuation reset. So I would really call it as year of consolidation. I would and currently we are over the last couple of quarters, the mostly the downgrades have typically stopped, and we are now looking at a good amount of earnings, upgrades happening over the various sectors and stocks and pockets. And I think that I call it a very, very healthy reset from what it was, unprecedented growth that we had seen in the last few years. And I think it was really required, an earning reset, a valuation reset, and, recovery from here. And of course, the consumption demand was also quite subdued in the last couple of years. And I think that should be past now. And I think we are looking at a very positive growth.
So, when you talk about the valuations, the fact is we know Nifty and Sensex, both delivered double-digit returns in 2025. Now that, like you mentioned, the valuations have corrected meaningfully with, what we see in Nifty, is trading below long-term averages. And, so from the valuation perspective, how do you assess the current levels, from a risk-reward perspective in 2026?
So I think if we talk about valuations, last, the decade which has gone by, we had close to 23, 24 times Nifty, valuations, Nifty trading at about 23, 24 times. And As we speak, come 2026, currently we are about 21, 22x Nifty, and I think if we look at the EPS growth, we expect from now to next 2 years, the next 2 years, we are expecting an EPS growth from 1250, 1225, 1250 EPS to about 1300 EPS, which is about 13 to 15% earnings growth from here on. The earnings projections is quite positive in terms of that the valuations are quite comfortable as far as current state of affairs is concerned, and we're not expecting the valuations to get elevated. We are expecting the valuations to remain very healthy in about 22, 23x over the next 1 to 2 years. With that, we expect Nifty to be at about 28,000 by the end of the year 2026, and Sensex to be close to 80, 88, 89,000. That I call it as a very good, healthy growth of about 13 to 14%. CAGR over the next 2 years.
Okay. What is your view on the mid and small caps? While we know, there was a decent corrections in both the spaces, okay, mid cap and small cap. Do you expect, the correction to last this year as well, or do you think that the phase of correction for both mid and small cap is over?
So I think certain pockets of mid cap still look expensive to me right now, and I know the reason for that is that a lot of companies which were trading at multiple times earnings, very high multiples, 30 times, 40 times, are now trading about for 25 to 30 times multiples. And I personally feel that small cap has corrected sharply, and I think small cap is very, very attractive at this point in time. And certain pockets of large cap I see, because large cap has been meaningfully corrected, but as far as the mid and small cap is concerned, I think we are at a comfortable zone as far as the mid caps are concerned. I mean, as far as the small caps are concerned, but as far as the mid caps are concerned, we are still a little away from comfortable valuations.
Okay, that was great. The other thing that is talked about a lot in 2025, we saw the FIIs. If you see, FIIs have been the net seller for nearly 15 to 18 months or more. If I see now, with the ownerships dropping to decade low, and rupee also we are seeing touching record levels. So why has India been avoided for so long? And do you think that FIs are going to return back? If yes, then by what time horizon is where we are looking that FIs might come back to India again?
So breaking this question into two parts, I think one is why the FIs have been net sellers. In the last 1 year of 2025, we've seen that FIs have pulled about close to 2.5 lakh crore, out of outflows from Indian equity markets. And I think currently, as we stand, I think there is a report which has come from Economic Survey, which says that the FI standing currently is about 17 odd percent, which is historic low. The DII, percentage in our equity markets is about 19%. And about mutual fund has again gone from about 6-7%. The MF flows have gone from 6-7% to about 11%. So as far as the FIs are concerned, largely it has gone because of the global phenomena. In terms of the global uncertainties which were starting from end of 2024 to 25. There was a lot of uncertainties around trade, US trade related issues, around Russia and Ukraine related issues, about and around India and Pakistan related issues. So a lot of uncertainty was going on, and at the same time there was AI related trade across US and global markets, including some of the parts of the Asia economies. A lot of AI related company have run up ahead of their fundamentals. So I think the most of the investors have realized that it is the valuation. When the valuation get uncomfortable, I think we have to come to the fundamentals, which is quality. India was highly, expensive close to 2 years back, 2.5 years back. I think now the valuations post the correction in the mid and small cap. I was just telling you that we are comfortable in the current valuations, which is about 21, 22 times earning. We are comfortable in the, as far as the earning trajectory is concerned. So I think the return of FI. That's the second question. I would say that we look the FI is to return back to India in close to second half of this year, and I think that is when the effect of GST cut, the income tax cut. We are looking at a very low inflation. I think we'll maintain that inflationary environment, a low inflationary environment, very good liquidity conditions in terms of the SIP flow that we are already getting. So I think that's about the FI. I think in the second half of this year we are looking FI to be back, with the bang in the Indian markets.
Okay. Mohit, another thing, I think again a lot of focus the market even today if we see, last year I think was a market of commodities. If you see, gold and silver, they have delivered extraordinary returns in 2025. With silver we see giving around 200% return. Okay, so I think there's a lot of belief in people that this could be a long multi-year bull market even for the commodities. So what do you think from your perspective, the investors should look at commodities, in 2026? Should they have a portfolio wherein a huge allocations is towards the, commodities, or what percentage of the portfolio the investor should be looking at commodity? So what is your view on, and also questions, again, while we talk about gold and silver, what is your view on copper as well?
I think, as far as the commodities are concerned, I believe that, we basically are looking at asset allocation framework as far as our portfolios of our clients are concerned. Gold and silver both have been rallying because of different reasons. Gold has been rallying because because of the, again, there's a global uncertainty around geopolitics, around trade, around Russia, Ukraine, and a lot of the other things which are going on. And as far as the gold is concerned, it's considered to be a hedge across across these uncertain situations, and it is considered to be parallel currency which people are looking at, the economies are looking at, the various central banks are looking at replacing US dollar. So I think that is what is gold increment in terms of the demand for gold from central banks, and as a safe haven requirement to hedge the portfolios, the requirement of gold. And as far as the silver is concerned, there is a very high level of speculation which is going on in the silver, and I think we should avoid this kind of speculation. Probably, I personally feel that silver has a long-term growth story. There is no two things about it in terms of the requirement and demand which is coming from industrial use of silver, which is from the EV manufacturing, the solar panels, battery, electronic components, etc. So I think there is a demand-supply gap, silver is concerned. But people are trying to do a lot of speculation in terms of shorting silver, in terms of taking a position on the silver, and I think that should be avoided. And I think if there are investors who have a very large portfolio across silver, I think they can look at booking profits. At every interval when the silver is going up. As a in-house, we are recommending gold and silver to be a part of the portfolio, largely gold. Because I personally believe that it has to be a hedge in the portfolio, has to be an strategic allocation in the portfolio. No doubt, no things about it. But as far as the percentage allocation, that was your second question, is concerned, I think should be about 15 to 16% odd in the client's portfolio, not beyond that. I think that we should stick to our asset allocation. I think that is where we'll be able to kind of be more comfortable in terms of the overall return portfolio, and avoid any kind of speculation, avoid any kind of longer short trades as far as the commodities.
And what about your view on the copper? While we've seen copper, delivering almost about 40 to 50% return in last, 20, 25 days. So do you think, is this a right, timing even for investors to enter now into copper, or have any sort of allocations in their portfolio into these metals as well?
So I think base metals, like copper, and aluminum and zinc, etc., are have become very, very important part of the client's portfolio, because largely, if you talk about any of these usage in terms of their industrial use, in terms of the usage in the defense, in terms of usage in whether it is EV, batteries and solar panels, I think there are talks about silver getting replaced by copper. There are talks about global minerals where there is a scarcity of the copper. The demand is going burst over the next couple of years. I think we will see a major shortage in the supply of copper, and a major demand as far as the copper and base metals are concerned. And there is a limited amount of manufacturing. It takes about 20 to 25 years typically to get a extraction site started, when once you find copper extraction from a site. So there'll be a major shortage of demand of copper globally, and I think that can be again taken as in part of the client's portfolio. I think don't again, my request and recommendation to the clients is, don't do speculation in any of these metals, whether it is copper, silver, or base metals, or aluminum or zinc. I think you can hold some of the copper through mutual funds. There are certain funds that we are recommending to our clients directly. You can hold certain stocks of these metals, which basically the companies who manufacture these metals. So I think that can be done, but as I said, it will be a long term view. Certain part of the portfolio can be definitely allocated to it.
Okay, okay. Moving next, this week we had the India EU, FTA deal. I just want to understand from you, that how big is this deal really, while they finally concluded, and this deal is apparently called as, the mother of all trade deals, basically. So, from a CIO lens, if you have to see how transformative, is this agreement for Indian economy or markets and for investors at the end?
So I think really happy you brought this question. I think when I saw this deal, I think this deal has happened after three consecutive trade deals, which has been concluded, prior to EU, European Union. And I think this particular deal, I'm very, very you know excited about, because this covers 25% of the global GDP. As far as the European Union and India is concerned, it covers about 2 billion people. And I think this is mother of all deals. I would really, it has been named rightly as mother of all deals, because simple reason that it gives you access to international markets. It gives you access to in terms of machinery, in terms of competitive advantage, both the countries can get. And there are a lot of industries which will be having a huge amount of advantage in terms of, as far as the custom duties are concerned, as far as the process and procedures are concerned, it will be a very, very high advantage to both the countries to ease out, to start the global trade between both the countries. I think, and I would call it as a strategic deal. And I think for the next couple of years, I see this as a very, very positive. In terms of the companies which are directly exporting to EU, the companies which are importing from EU, and I think indirectly there are a lot of industries which will get benefited out of it. Largely, manufacturing industries who are taking advantage of it. So I think this is one of the exciting things which has happened recently, and I think I'm very bullish about it. In terms of it is quite positive as far as the earnings growth trajectory of manufacturing and export related companies are concerned, and it is a long term earnings growth trajectory for them.
Any particular sectors, that you feel, would benefit the most out of this trade deal?
So there are a couple of sectors. There are engineering goods. There is sectors like textile. We have auto ancillaries. We have sectors in terms of chemicals. So all these sectors will benefit a lot. And I think if you talk about largely where there is a exchange of engineering capabilities, I think those are the sectors in terms of exporting to the European Union. Companies which are manufacturing all these components, whether it is auto-related components, whether it is engineering goods, whether it is textile manufacturing, exports. So all these sectors will IT-related sector will get a lot of benefit because a lot of business will happen with EU, in terms of trade agreement. So I think these are the sectors which will largely be benefited from this entire trade deal which has happened with the European Union. And large caps, will largely most of these companies and large cap cyclicals, export related companies will be the beneficiaries of it.
So while you're talking about the large cap, and we've spoken about everything, I think we've discussed about earnings, recovery, trade deals, and commodity volatility. And given the global uncertainty, that is hovering around, what would be your closing thought on, ideal asset allocation for 2026? Where do you think that, for maybe, any new investor or any investor right now entering into the market currently, what should be the ideal asset allocation that a investor should be looking at in this year?
Firstly, equities, as I said, it will be the core asset. As far as the client's portfolio are concerned, there is no two things about it. Uh, Within equities, I think to large extent I would stick to large caps because there is a quality, there is strength in terms of the balance sheet. There is good amount of growth rate in terms of contribution to the GDP across the value chain. And to some extent, I would also have some certain pockets in mid cap and small cap, which are very very attractive at this point in time. So, as I said, a major portion of your asset allocation would be equities. Then, to selectively, we are also looking at fixed income instruments where the yields have significantly come down post the interest rates cut. We are looking at certain corporate bond. Liquidity is quite strong as far as the fixed income portfolio is concerned, and I think certain part of the portfolio with yields coming down and overall returns being very good, as attractive as far as debt funds or fixed income portfolios are concerned. Then you're also looking at the third part is your commodities, which includes your precious metals, largely precious metals and base metals, and I think this has to be a mix of major portion between gold, as far as gold is concerned, because again, it has to be used as a hedge in the portfolio rather than any speculation. Probably some part can be contributed to the base metals, which includes copper, aluminum, zinc, etc. So I think it has to be a multi-asset kind of
Multi-asset,
portfolio,
yeah,
which
yeah.
multi-asset kind of portfolio which will actually work very well in the environment where there is a lot of uncertainty still. There is a lot of volatility. There is a lot of speculation going on across various assets. Right now, and I think we would stick to our asset allocation that will actually help investors to kind of be more comfortable with their investment journey. So I think that should be the idea. Equities, fixed income. Large part should be equity, certain part of the fixed income, and gold and silver as a hedge, and majority part should be gold, and base metals to be as part of the tactical portfolio to take the advantage of the overall metal story which is going on.
So some final, closing thoughts from you, Mohit, when while we are seeing markets are being, very volatile, and every other day I think we wake up to some constant negative news around the market. So what a mindset the investor should be having right now? Do you see any a mind shift change that the investors consciously needs to bring in them, or how would you see that?
So, Rinku, I think one of the major mindset which needs to be brought about change is to have mindset towards more constructive creation of a portfolio which take care of your long-term goals. And I think rather than looking at what is going on in the market in terms of momentum, it should be more of a portfolio driven approach, more of an asset allocation driven approach. How you want to look at your corpus over a period of time. That's your dependent upon your goals, depending upon your risk profile. It has to be more meaningful, driven portfolio. I think should not be swayed away with whatever is happening in the market. Should not be looking at all the voices which are going on, which is kind of disturbing, giving you a little disturbing on a daily basis. I think you should stick to your asset allocation, and that should be the way forward for the investors. And I think I was talking to one of the investors. We were talking about silver on his portfolio, because that particular investor had bought a lot of silver. So I thought, let me just share with you. So I told the investor that you decide whether you are a trader or you are an investor. So if you are a trader, you can probably do speculation over the silver, but if you're an investor, then go for the asset allocation framework. So I think the same thing we have to stick. We are not traders, we are investors. So for an investor's mindset, the key thing is reduce noise, reduce speculation, and whatever is happening in the market, and stick to your asset allocation. And I think that's where you get your peaceful sleep of night, and
That makes a lot
you'll
of
be
sense. That makes a lot of
yeah,
sense given the current market scenarios that we are seeing. Uh, you
yeah.
know, yeah, I think Mohit, it was great, discussion, hearing your insights, for from be it from the commodity perspective or valuations and earning and different asset classes that we discussed. Privileged to have you on the
Thank
call,
you.
and
Thank you.
thank you so
It was
much.
a pleasure,
Thank you
Rinku.
so much.
Thank you. Thanks a lot, Rinku. Thank you so much.